Okay, what is up, tycoons? What's up, traders? Super excited for today's video. Coming at you guys with another natural gas update. I'm doing natural gas updates every single week. We're going to talk about why I've been bullish on natural gas. And it's this chart here, and specifically, I'll explain it a little bit more in detail. We're also going to cover some of the recent news. All right, Russia sees natural gas revenues collapse. And then we're going to take a look at some of the forward basis curves. All right, the tightening south central balances, sliding rig count. All right, we're going to look at the lower 48 working gas difference from a 5-year average. All right, and also go over some of the supply and demand, some of the LNG and the rig count data. All right. So we're also going to break it down the Boyle chart, okay, and take a look at the bullish structure that I have right here that I'm kind of tracking. We're going to see if this plays out or not. We have the cold bearish structure, which we actually just flipped a key level. I'll break that down. We're going to take a look at the natural gas futures 4-hour chart. And then we're also going to look at the monthly chart so you can get a big picture idea of the monthly chart supply and demand zones, as well as the natural gas spot price, RSI, and MACD signals that I like to use. This is a really good chart to help break down some of the different signals and strategies that we go over on UNG and Boyle. All right, and then this is a nice little chart here of the different UNG buying opportunities based off of those strategies and, the potential returns you could have made on some of these trades. You can always email me for a one-on-one session if you guys want to do a one-on-one coaching at ZachlyTrades@gmail.com. And as always, the content provided on this channel is for informational and educational purposes only. Now, this is why I've been bullish on natural gas. And the reason being, all right, is because when we come down below this level here, which is that $2 price range on the natural gas spot price chart, that's what we're looking at right here, we can see that natural gas recovers very well afterwards, right? And so if you can get in at the lows here rather than buying up here in the highs, your odds of success are much more increased. Okay, so we can see it goes from anywhere from around 91 days all the way up to 315 days, with the shortest period being roughly about a month that it stays below that $2 price range. And we've been consolidating in this area for a good little while, throughout 2023. Okay. So that's why I was really interested in natural gas, is because, I see that, well, we could take all the way up to a year, right? This was 245 days. This was 315 days. So let's just round that up to a year. And so my thinking was, hey, we could stay and consolidate around that $2 spot price natural gas for up to a year. But afterwards, it's always recovered to $3 or $4 at least, right? And so that would be a nice move if you can capture that move. So this is one of the main reasons I even started covering natural gas. Now, Russia sees natural gas revenues collapse, defying weakness in WTI and Brent. Dubai soars to prominence. The Brent Dubai exchange of futures for swap spread, a key indicator of arbitrage from Europe to Asia, narrowed to a 2-year low recently and slightly even dipped below zero this week. A strong Middle Eastern benchmark is largely coming from Saudi Arabia's $1 billion production cut pledge, as well as higher availability of U.S. crude in Europe, pushing down the NW European market. Chinese refiners have resumed purchase of North Sea crudes as several VLCCs have loaded in past weeks, with a whopping 54 million barrels of West African oil having been fixed to Asia in June. At the same time, China's state-owned companies have traded over 1,300 Dubai partials in Platts Dubai / the Oman window, the second highest on record, with Unipec rising to become a primary seller and PetroChina heading the list of buyers. Now we have tightening south central balances and a sliding rig count fuel more price gains in natural gas futures. After a rough start, natural gas futures extended their gains on Friday as traders continued to digest the latest storage data, which showed further tightening in the important U.S. South Central region. The August NYMEX futures contract touched at 2.634 million British thermal units intraday low before buyers swept in to send the prompt month 9.7 cents higher on the day to 2.798. All right, and that's kind of, this is the data that they're looking at right here, the forward basis curves for the California regional 24-month outlook, right? And you can see the different regions here: SoCal border average, SoCal Citygate, etc. This is some of the data, the chart basically that this article is going over. We have the lower 48 working gas difference from a 5-year average. And then in blue here, you can see the weekly net change difference from a 5-year average. All right. And so working gas natural stocks totaled 2,805 billion cubic feet for the lower 48 states as of June 23rd, nearly 3 months into the refill season. Relatively high natural gas production and moderate demand for natural gas resulted in increased storage balances. Net injections into working gas storage since April 1st exceeded the 5-year average by 28%, leaving working natural gas stocks at 66% of working gas capacity. Working natural gas stocks entered the 2023 refill season at a 19% surplus to the 5-year average, compared with a 3% deficit at the start of the 2022 refill season. In the first half of 2023, record high levels of natural gas production have pushed natural gas inventories well above the 5-year average. Since April 1st, dry natural gas production rose 6%, or 5.6 billion cubic feet per day, compared with the same time last year, which more than offset the 3% increase in natural gas consumption for electric power and the 7% uptick in deliveries to liquefied natural gas terminals, according to the data from S&P Global Commodity Insights. Now, from supply and demand, okay, so according to the S&P Global Commodity Insights, the average total supply of natural gas rose by 0.9% compared with the previous report week. Dry natural gas production grew by 0.1%, and the average net imports from Canada increased by 15.9% from last week. Total U.S. consumption of natural gas rose 2.4% compared with the previous report week, according to data from the S&P Global Commodity Insights. Natural gas consumed for power generation rose 4.1% week over week, and the industrial sector consumption was unchanged, and residential and commercial sector consumption increased by 1.2%. Natural gas exports to Mexico decreased 1.6%, and natural gas deliveries to U.S. LNG export facilities averaged about 11.5 or 0.6 billion cubic feet per day higher than last week. Now, when you look at the rig count, according to Baker Hughes, for the week ending Tuesday, June 20th, the natural gas rig count was unchanged from a week ago at 130 rigs. The Haynesville dropped 1 rig. The Permian added 1 rig. The number of oil-directed rigs decreased by 6 rigs from a week ago to 546 rigs. The Permian dropped 2 rigs. The Williston dropped 1, and 3 rigs were dropped in unidentified producing basins. The total rig count, which includes 6 miscellaneous rigs, stands at 682, which is 71 fewer rigs than last year at this time. And from an LNG standpoint, when you look at the liquefied natural gas at the pipeline receipts, the overall weekly natural gas deliveries to U.S. LNG export terminals increased by 5.1% week over week to average 11.5 billion cubic feet per day this report week, according to data from the S&P Global Commodity Insights. Now, natural gas deliveries to terminals in South Texas increased by 2.5%, and deliveries to terminals in South Louisiana increased by 8.1%. Natural gas deliveries to terminal outside the Gulf Coast were essentially unchanged. Now, vessels departing U.S. ports: 21 LNG vessels, 5 from the Sabine Pass, 4 from Freeport, 3 each from the Calcasieu Pass, Cameron, and Corpus Christi, 2 from Elba Island, and 1 from Cove Point, with a combined LNG carrying capacity of 75 billion cubic feet, departed the United States between June 22nd and June 28th, according to shipping data provided by Bloomberg Finance. Now, this is the futures chart. This is our 4-hour chart. And in the last video, I highlighted and mentioned we had this gap down to fill, right? We had this gap down here. That's what that blue box is. And most of the time, about 90% of the time, you're going to see these gaps fill, right? We see this gap filled. We see this gap right here filled. And we also see that these other gaps here filled as well. Okay, so you want to be mindful of these gaps whenever we do get these gaps, and, just have some type of a game plan. Now, sometimes they're going to fill the gap and then reverse, right? And that's what we did here recently. We came up, filled the gap, and then we ended up actually reversing. And sometimes, it's going to fill the gap and then continue heading in that direction. So you want to be mindful of these either way. And, one important thing, this blue line is our year-to-date anchored VWAP. Our yellow line here is the month-to-date anchored VWAP. We're starting a new month now. And you can see here that we are above the year-to-date anchored VWAP, which is really pretty significant. What this basically means is that your average buyer, if they were dollar cost averaging throughout the year, they're actually in the green now, right? And they're above the year-to-date anchored VWAP. So that's pretty interesting to me. If we do see some pullbacks, look for some type of a bounce near that anchored VWAP. That's going to be really interesting to see. Okay. We do have a little bit of a rising wedge forming here. Okay, there's been a couple rising wedges that have formed and have resulted in a pullback. But until we break the trend line, that's really when we're going to get confirmation. And so we're going to look for that confirmation rather than trying to short natural gas futures ahead of time, because the structure could break. We could chop sideways, or we could continue extending up higher and break through the structure. But if we do break that trend line, I'm going to be looking to see if buyers step in right around that month to day and that year to day anchored VWAP. So let's take a look at a bigger picture. All right, and let's go over here to the monthly chart for the futures. Now, our monthly time frame looks really, really good. Okay, and the reason being is because the month officially closed and we had a very, very strong bullish candle. This candle right here. It was a nice monthly close. And what was nice is we were actually able to close in our overhead supply zone. All right, we can see here, here, and here each time on the monthly chart that we've come up into this supply zone, we've had a strong push back down into our demand zone here. Now, the demand zone is very strong. Okay, for years, it's been tested many times. And each time prices drop down into this level, demand and buyers have stepped in and pushed price up higher. We're currently battling our supply zone right here. And what would be healthy would be to be some consolidation. Okay, these supply zones, what these are is these are supply imbalances. Okay, and to explain that very briefly, essentially there's an imbalance of supply in there, which just means that there's more sell orders than there is buy orders, and that imbalance pushes price lower, right? Back down to your demand zone. And so if you can absorb those sell orders, which is what we did for the first few months of the year, we came back into those zones, we absorbed some of those sell orders, but the imbalance was very strong and pushed price down. But you can see here now, we're starting to close up in this area. And if we can continue to absorb those sell orders, then we may actually get a demand imbalance here. And that's when we would get a breakout to our next supply zone and our next area of liquidity. That's what we're going to be looking for, when you're looking at the larger timeframes on the natural gas futures, is can we consolidate through here and try to move up towards the next overhead supply zone? If we can do that, then we could see some nice returns in natural gas commodity ETFs. Now, this is the spot price RSI and MACD signals that I like to use, and we won't spend forever explaining them, but essentially I like to combine divergences with the MACD. All right, so divergences on our RSI here along with the MACD. Okay, and the reason being is because your RSI is going to be a leading indicator, and then your MACD is going to be a lagging indicator. So the lagging indicator is going to tell you what happened after it's already happened, and the RSI is going to be a leading indicator and tell you what's happening right now with price and what could happen in the future. So for instance, over here, we're creating higher highs on the price while creating lower highs on the RSI. That's a simple term known as bearish divergence. So our leading indicator is saying we could have some bearish activity in the future. We look for confirmation on our lagging indicator. Our MACD here gets a bearish crossover, and then that's when we get the move down. Same thing happens to the bullish side, right? Over here, we're creating lower lows on the price. We're creating higher lows on the RSI. So that's a bullish divergence. We get a MACD crossover. That's our lagging indicator. And once we have two signals rather than one, we can have more confidence in our trades and in our plays. Now, that's not to say that every single play is going to be 100% guarantee, but this is something that really does help out a lot. Okay, rather than just buying into something blindly. All right, and it's worked many, many times. Okay, higher highs, right, lower highs, MACD crossover to the downside. Over here, lower highs, higher lows, MACD crossover to the upside. And you can see really we've been building this very long bullish divergence where we've been creating nothing but higher lows, bouncing off of this trend line here very strongly. And meanwhile, the price of natural gas in the natural gas spot chart continue to just head lower, and we've actually seen a strong move from below $2 all the way up to 268. So pretty strong move right there already that we've started to see. And a lot of people are looking good if you've been in the natural gas trade here in the short term, right? Now, if you were buying up here or in here in these time periods due to things like decay, and a couple of the other factors in things like UNG and Boyle, like the contango, different things like that. Your shares may not be looking so pretty. There's many different ways to hedge yourself, from the decay. And I have several videos on that topic. I also have a dedicated video completely to the myths surrounding Boyle and UNG when it comes to the decay and the contango. Those are some really good videos you guys may want to watch after this video. Um, this is the cold bearish structure, okay? And so this is another one of the reasons that I'm actually pretty bullish on things like UNG and Boyle right now. But I'm more of an options trader, so I don't have any option trades on these yet, but I'm going to be looking to potentially open some up this week. And the reason being is because I mentioned this 61.8% level here, okay? This is $60.36 on cold. And you can see last time we broke below it and we tried to flip it to resistance, but we actually gapped up over it, right? And then we had a gap and go. We had a very strong move up there. All right, now we've come back down, and I mentioned we were testing it again, and we were also testing our year-to-date anchored VWAP. Well, what we've done, and what I mentioned we need to do, is we need to get a breakdown retest and flip this to resistance for it to head lower. And you can see we actually did that very textbook, and so we're below our year-to-date anchored VWAP, and we're also below that $60.36 level. If we can stay below there, I think that cold could end up creating new lows and starting a new downtrend, right? Rather than the uptrend where it had a low, higher low, higher low, higher low, we actually now have a low and a lower low. And we're going to see if this downtrend can continue and if we can come down and potentially create a new lower low on cold, right? So that's one of the things that I'm really looking at right now. If you look at UNG and the different buying opportunities that you've had over the past, few months, okay, this is February right here, and you can see we started to form this bullish divergence, right, where we're coming in and we're making a low and then a lower low. And what happens, we end up seeing a low and then a higher low on the RSI. That's bullish divergence, and that led to a 40% trading opportunity. No one's going to be perfect. You're not going to be able to capture the whole 40% move, but if you can capture some of the move 5, 10, 15, 20% along the way, and start to, take profits, use risk management, then you can start to build gains successfully as a trader over the long run, which is what you want to do, right? You want to focus on small, consistent gains. Consistency is key rather than just chasing that 1,000%, 500% play. Now over here, what did we do? We ended up coming back down again, creating another lower low, creating another higher low on the RSI here. And then we get our lagging indicator right here with the bullish crossover that led to a 16.89% rally. Then what do? We come down, make another lower low here. This led to a 26.8% rally because we're still making higher lows on the RSI. Again, we get another lagging indicator, our MACD crossover here. And again, 26% rally. Then what do? Come down, create another lower low, get another MACD crossover, and we're continuing this trend of making higher lows here on the RSI. And this was about a 33.55% opportunity. Based off of each one of these single individual entries, right? So yeah, that's UNG. This is Boyle, okay? And it may look a little bit complicated, but don't panic, right? What I'm simply looking at is a potential cup and handle here. So here's our nice little cup. Here's our handle forming right now. And we did get a nice 1, 2, 3, 4, 5 up. Okay. And typically the market is going to move in 3-wave and 5-wave structures. And we've got a 1 down and a 2 up. So we should technically be due for a C down. Now, this is on the daily time frame. If I zoom in, I'm sure I could be maybe able to, find an ABC down if I wanted to on a lower time frame. But I'm leaving the possibility open that Boyle may need to come down to 57.23 before getting its next move. Now, we don't have to pull all the way back right there. Okay, cold, I mentioned the cold chart looks like it's holding that significant level to stay below, and that would result in it being bearish, and that would result in Boyle being bullish. And essentially, if we hit this cup and handle, the targets are going to be right around $89.15, 102.63, and 116.11. That's not to say that we're going to hit all three of those, but the first target is going to be $89. And if we do come up to that level, then we'll see what the price action is looking like if it can come up. And the reason that these are some of my targets right here is because we have this massive push down that we had, right? And we haven't really had any type of a strong retracement, right? We've had these little dead cat bounces, I wouldn't even really call those a retracement after such a strong move down. So if we were to get a healthy retracement, Boyle could run up to these three price levels that I gave you guys. That would still be a healthy retracement territory from that large move to the downside. So as I mentioned, we've already formed that cup. All right, we have all the way down to 57.23. If we break 57.23 from support to resistance, then most likely we're going to see a reversal on Boyle, and it's going to come back down and try to retest some of its previous lows. Again, Boyle also has that bullish divergence, right, where we're creating these lows, lower lows, lower lows, lower lows, lower lows, and still creating higher lows here on the RSI. So if we drop back down, okay, this RSI trend line is going to be really key and really important to see, does it continue to bounce off of there, and could that be a bounce right around that 57.23 area? Or, if we end up breaking through this, then most likely we're going to break through some key levels on Boyle and try to get that reversal to the downside. So, these are all of the key things that I'm really looking at right now when it comes to UNG, when it comes to Boyle, when it comes to the futures, when it comes to cold, right? You need to be looking at the futures, especially if you're trying to trade something like UNG or trade something like Boyle. It's definitely important to chart those up as well, not just, UNG and Boyle, okay? Because they're going to move differently, and you'll be able to see the difference in the price action once you start to actually actively monitor them. Hopefully you guys enjoyed this video. If you did, smash that like button, subscribe to the channel for more, and I'm out.